We have a market that's now pricing in, a rate cutting cycle that could begin as early as March, first cut in full by May, and maybe 5 or 6 cuts
Let's
in
talk about the
2024.
motivation behind that, if you could, because I know that, economy slowing is one narrative. The Fed winning, this inflation fight is another. What about just plain old, they need to get it down so, corporates can refi and live to fight another year. So what are your reasons for believing they will follow through? Just assume the market's correct. They've pulled forward these rate cuts. Fed follows through in March. Why?
This short clip is presented by Edge. Edge is our pro-to-pro advisory service, which is all about the macro with a focus on one-to-one engagement with the hedge fund manager, Craig Shapiro, and direct access to LaDuc Trading founder, Samantha LaDuc. For more information about Edge, visit www.laductrading.com/edge.
So, look, I mean, the market has consistently in this tightening cycle run ahead of the Fed, in a way that looks more like the Fed's reaction function during QE in a low inflation environment than it should during QT and in a high inflation environment, and has consistently been wrong in that assessment of what the Fed is going to do. I mean, I think it was a year ago where the market was looking for rate cuts this year in 2023, and obviously we know that didn't play out. So I would just start with that, which is it's not always been the case, particularly over this tightening cycle, that the market has been right in its assessment of understanding the Fed's reaction function. And I think now, once again, the market is incorrect. But why the market has moved so aggressively, I think here, again, is muscle memory about these growth slowdowns and what the Fed usually does. And look, I think there's been a reasonable deceleration in the data in the economy, really starting at the end of September, but it seems like it got worse in October and through the first 2 weeks of November. And I pointed this out in the chat yesterday, but the Beige Book yesterday, in the summary paragraph, mentioned that the economic activity has slowed. And that's data, anecdotal data, really through November 17th. So that's like the most updated amount of data that we have. Economic activity slowed. I went back and looked. The last time the Fed's Beige Book said economic activity has slowed they made that transition from growth to slowing was in March of 2008. That's outside of COVID, right? So COVID, obviously things fell, but you have to go back to all throughout the last 15 years, the Fed has never said economic activity has slowed. So they are definitely anecdotally
that's a good catch.
They're anecdotally seeing something in the economy that is concerning to them on the growth side that the market is also picking up on. And so there is a belief that, well, if and when the economy slows, the Fed is quick to react. Now, I also went back and looked. A prior time when they made this assessment was in, I believe, the middle of 2000. And it also, at that point, once they made that assessment, it still took them a couple quarters to cut. So even with that being said, the market is still anticipating a cut sooner than I think is possible. But that is the logic that we are going through a fairly significant growth deceleration that is now. Inflation will be rapidly falling back to 2% because of this slowdown. And that would be the reason for the Fed to put in some of these, I guess they would describe them really as normalization cuts, which is they need to cut rates in order to prevent real rates from rising further, which would be even more restrictive to the economy, right? As inflation falls, if they do nothing, they are increasingly restrictive because real rates are rising. So they do these, quote, normalization cuts to keep real rates kind of in balance and only do a sufficient amount of restriction. Or if they want to, at some point, do more, that would provide more accommodation. So that is what the market is, that is what more people in the market are an increasing belief. What we had this week was we had Waller. I listened to him live. He was asked a question by Nick Timiraos about the Taylor rule, which has to deal with, which is dealing with this idea of cutting as inflation falls and not allowing real rates to rise, and how many readings of soft inflation would he have to see in order to say that maybe, yes, it's time to cut rates. And he kind of, I think he thought he was giving an academic answer, which is that, yes, if we were to see 3 or 4 or 5 consecutive months of inflation falling back down towards our 2% target, yes, we could be cutting rates. He wasn't saying that was going to happen. He wasn't endorsing that he expected inflation to fall for the next 3 to 6, but it was interpreted that he was kind of on board with this idea that, well, if the market is right on its call that inflation is falling rapidly, that the Fed could be cutting as early as 3 to 4 months from now, which is March. Subsequent to him saying that, we had the next 5 Fed speakers basically all come out and say something along the lines of policy needs to remain restrictive for some time. We could still be raising rates. We're not even thinking about cutting rates. The talk of cutting rates is premature. So in my view, the Fed speak in the last 2 days kind of really pushed back against that Waller interpretation and has pushed back against the market pricing in an increasingly aggressive rate cutting schedule. Now, Powell speaks tomorrow. He's speaking in a forum. It's a fireside chat at a forum where he's not really, the title, I'll just read it. The title of his fireside chat at Spelman College was something about operating in a post-COVID world. So it's not clear that this is a monetary policy forum per se, but I would imagine if he's doing a Q&A, which he is, and he's giving text, that there's a reasonably good chance he's going to make some sort of monetary policy.
What time is that again?
Speak the first at 11, and then he'll be again at 2:00 where he's part of a roundtable. But during that roundtable, which is on tech, innovation, and entrepreneurship, I think he won't be speaking, really in that. But the first one, he is the speaker. So, look, I think, and then the Fed goes into blackout period, right? So he has the ability to set the agenda for the next 2 weeks of trade. Should he want to push back against the market pricing, or will he embrace the market pricing? Look, I think if he is to embrace this market pricing of a rate cutting cycle that's imminent, the market is going to scream higher over the course of the next 2 weeks, where we know the seasonality and the flows become very supportive, right? We have options expiry is early, this month on the 15th. And so
right after FOMC.
Right after MC. But still that lead into expiry is typically a fairly bullish period, as we have all the hedge buybacks and the like. And so I think there is a chance of, in that environment where the market is screaming higher and rates are falling, that the dollar gets hit and inflation expectations start to rise again. And we're back into this song and dance, which the Fed has been loath to want to be in. And after all the speak today, I would be very surprised if that's the tack that he takes, but it is possible. It is possible, and he's done it before where he's punted on the ability to be hawkish, but we can also look back at times where he has been hawkish. And I think if he were to come out tomorrow and reiterate this idea that talks of cutting are premature, I think that the market would be forced to, push out its timeline to receiving those cuts. I think there'd be an expectation that the dot plot would then come in hawkish in 2 weeks, maybe suggesting, no cuts for next year, only 1 cut for next year, in a way to try to push back against the market. But, we'll know more at 11 o'clock and we'll watch it live. So, but it is going to be a very important speech and commentary, because we are heading into blackout period. And the data, like I said, the data on inflation has been slowing, although, core inflation is still sticky and high. I think that there's less desire for the Fed to act rapidly, but the market has really pushed aggressively to that bias.
The full episode is available to all Edge paid subscribers. Visit www.laductrading.com/edge for more information.